Hey everyone, welcome back to the channel. Today we're doing a little bit of a different style of video. I'm going to be talking a little bit more to you guys this way. We're going to be doing some examples written, so it's a little bit easier to understand. But this is kind of going to be the theme going forward. I'm going to try something new. Let me know what you guys think down below in the comments. But today we are talking about first-time home buyers, and in particular, everything you need to know about mortgages and their interest and something called amortization schedules. These are really important to understand before you get into the predicament of having a mortgage and understanding how it works, how much interest you pay, how interest rates play a role is very important, especially in a high interest rate environment like we are in right now. So I hope you guys all enjoy this one. It's a really good one. I hope you can follow along. If you have any questions, feel free to reach out to me and yeah, enjoy. Welcome back everybody to Investonomics, your personal finance guide. I'm Jay. Today we're talking about mortgages and their interest and so-called amortization schedules, which is very important for you to understand when you are a first-time home buyer or if you're just buying a house in general and don't know how this works. So it's one of the biggest oversights when people are buying a house and they don't actually know how it works exactly, how much interest they're paying over the term of the loan, and just in general, the terms of their mortgage, they don't fully understand, and so they're kind of at a disadvantage against the big banks and lenders. So today we're going to be talking about how you can calculate the total interest that's accruing on your mortgage over the life of the mortgage, which is called the amortization term, which is typically about 25 to 30 years. We're also going to talk about how to break down each payment and see how much interest is being paid at every single payment, and subsequently the principal amount that's left over. So we'll talk about this, and then we'll end with ways on how you can reduce the total interest that you're paying over the life of your mortgage, because as you'll see in a little bit, it's very substantial. So let's start with some simple terminology here. So mortgage amortization. This is the life of the mortgage. So the average in Canada, for example, and the United States is about 25 years. What this means is you are making monthly payments. So your monthly payment that goes towards your mortgage, interest and principal all included, is called your mortgage payment. Now, the amortization is when you're paying down your loan by making these monthly payments. So that, in effect, is your mortgage amortization. And again, it's over that 25 years, so that if you make that payment for 25 years monthly, your balance at the end will be zero, and that's the idea. So it varies a little bit because if you know mortgages, you have the option of having a fixed rate mortgage or a floating rate or so-called adjustable rate mortgage. A fixed rate mortgage is a little bit more simple because the payment is not going to change over time. But if you choose an adjustable rate mortgage, this is something that can change as the economy changes. For example, right now the average interest rate is between 6 and 7% in North America. And of course, this will change when the Federal Reserve and the Bank of Canada changes their interest rate policies, either increasing or decreasing the interest rates. And this, in effect, will change your whole amortization schedule, which is the payments that you make. And this will change the total amount of the payment. So if interest rates are rising, you're going to see a payment that goes up. And if they fall, you're going to see a mortgage payment that goes down. And as you can see, there might be some risks involved with an adjustable rate mortgage. Now let's say you already know how much you're paying on a mortgage because you have one or you've run a calculator, and we'll go through this in a little bit on how to do this exactly. But say you know what your monthly mortgage payment is. At this point, you can then actually calculate how much of that mortgage payment is interest. And in specifics, we're talking about the first mortgage payment here. So in order to calculate what exactly the interest will be, all we need to do is divide our ongoing interest rate, if you know it, on your mortgage, and divide that by 12. The reason we do this is because the rate that's quoted is an annual rate. So if we divide this by 12, we get a monthly rate. So for example, in our examples here, we talk about 6%. So in effect, it would be 0.5% per month. So all we need to do then is multiply the total face value of the mortgage by the monthly interest rate to calculate how much the current interest is going to be on your monthly payment. For example, if we have an $800,000 mortgage, we're going to have $800,000 multiplied by 0.5, which is the interest rate, and that gives us a total payment of $4,000 for interest for that month. Now, as we'll show a little bit later, this is based on a $5,154 mortgage payment, dollars, that is. So you're going to have the vast majority of your first payment being interest. And this is part of the first problem, since you're not actually paying your home back very quickly. So subsequent interest payments are simply the current loan balance multiplied by the monthly interest rate. As the mortgage is paid off, interest becomes smaller and smaller. So similarly how we calculated that first month of interest, we can do the same thing the next month by simply subtracting what we've paid in principal, which is the total payment subtracted from the interest payment. And you can see that here. We can then have that we subtract this from the total balance of the mortgage and then recalculate what the interest will be based on this new balance. So in our example, we have $1,154 that is not interest and therefore is principal. And once we know that, we can subtract that from the $800,000, get the answer for our outstanding balance on our mortgage, and from there, we can calculate the interest due, which will be slightly less than $4,000. So in this respect, the total interest that you're paying every month will continue to decrease until you have fully paid off your mortgage. So for example, once this is half, your mortgage balance is half of what it was at issuance, that means that only half of the interest is going to be payable on your monthly payment. Another very important thing for you to know about mortgages is the fact that you need private mortgage insurance if you put down less than 20% of your down payment. So the reason they do this is in order for the bank to actually make money if you default or foreclose on your mortgage. And this is pretty backwards because you have less money down, more risk for them, but you are paying the insurance to cover the bank essentially for if you foreclose or go bankrupt. So this is another thing you need to take into consideration, and I'll show a graphic right now. But essentially what this means is that you shouldn't put down less than 20%. So if you are in the situation, try to save a little bit more. Make sure you have 20% to put down as a down payment, and otherwise just try to continue saving. And we realize that prices are pretty out of control right now, and so this can be quite a problem, especially if you're looking at $1 million condo and you have to put $200,000 down. It's not easy to do. Another thing is that if you do put down more than 20%, so 21% and over, you can opt for a longer amortization term. Essentially what this means is that you can go higher to about 30 or even more years, whereas under 20% and at 20%, we are capped at 25 years. Another thing that people are often confused about when it comes to mortgages is the difference between a mortgage term and the amortization term. So the difference is that the mortgage term itself is usually between a few months to 5+ years, not much longer than this, whereas the amortization term is typically higher, between 25 and 30 years, as we just talked about. The mortgage term needs to be renewed, and at this point you can opt for a different interest rate if one is available. You can choose between fixed and adjustable, and it is renewed every time there's still a balance owing on your mortgage. So in the case of a 5-year mortgage term, you would renew this 5 times, if 4 times, I guess, because 25 years. You would renew it every single time after 5 years until the balance is paid in full. In a way, then, it allows you to reset your mortgage, which is useful and also allows you to take advantage of better interest rates, or if you're unlucky, to get worse interest rates, such as the people that were refinancing or getting a new mortgage term in 2021 and 2022, and much of 2023 as well. So again, you have that interest rate risk that you're going to be dealing with. Another and one of the most important things to be familiar with when you're looking at a mortgage is called the amortization schedule. And as it sounds, this involves the total payment that we have due the principal portion, the interest portion, and it actually plays this out by month. So you can look at the whole schedule top to bottom, and it should have every single payment in that mortgage's life. So it's a good thing to look at, and especially when you're changing interest rates, the payments will change, the amount of interest and the amount of principal will change. So it's good to always take a look at these amortization schedules, and we'll take a look at one here. So now let's turn and take a look at our example. So first we need to set up exactly how it's structured. So imagine we want to buy an apartment for $1 million. And this is pretty cheap in Toronto, believe it or not, which is where I'm basing this assumption. We have to put $200,000 down as a down payment, and the interest rate we're going to use is a little bit higher than the market, being conservative at 6%. Now, the formula for calculating the monthly payment for a fixed rate mortgage at 6% is the following. So we do F times R divided by 1 minus 1 plus R to the power of negative N. And in this case, the F in the formula is the total value of the mortgage. The R is the monthly interest rate, which is calculated as the annual interest rate divided by 12 months, which is in our case 0.5%. And the N is the total number of months in our mortgage term. So in our case, it would be 12 times 25, which is 300 months. So doing this calculation then, all we really need to do is plug in the numbers. So we plug in $800,000 for our mortgage amount. We get the decimal version of the rate divided by 1 minus 1 plus that same rate to the power of negative 300. When we do this then, this gives us a monthly payment of $5,154.40. It's worth noting here, by the way, that this will vary slightly when we use different calculators on different websites, since they use slightly different assumptions, slightly different interest rates, and slightly different compounding. But in general, you should be able to get a ballpark of exactly what this payment is, and this is the legitimate way to do it. So as the next step, we can move on to the next month, down kind of the second row of our amortization schedule. And first things first, we need to subtract that first payment in terms of principal amount from the total mortgage balance. So if we do $800,000 and subtract $1,154.40, we end up getting $798,845.60. So this is then left on the total mortgage balance, and we can again multiply this by that monthly interest rate to calculate the total interest for that second month's payment. So in this case, that ends up being $3,994.20, which is, as you guessed it, less than $4,000. So this means that more, or $1,160.20, is actually going towards our principal payment to pay down the mortgage overall. This can be done over and over until we reach the very end of our amortization period, which, if you're smart, you'll use Excel and automate this. It's a fairly simple formula to implement. It's just a recursive function that goes all the way down. If you have questions about this, I can do an example for you as well. This means that principal over time is increasing while the amount of interest is decreasing with each payment. For example, if we pay down halfway through our amortization term, or 12 and a half years, we've likely paid down roughly around $400,000 of our mortgage. So there's going to be $400,000 outstanding. Because this is half of the total mortgage amount, we're going to have roughly about half of the interest, or about $2,000, which means that just about $3,154 is being paid towards principal. So as you get closer to the end of your mortgage term and the amortization period, and your mortgage is almost paid in full, the less and less interest you pay and the faster you build equity. Now the real kicker for us is to take a look at how much interest we're going to pay over that full 25-year amortization period. This is really shocking, guys. Pay attention to this. This is crazy. So to do this, we can use the following formula. It's pretty similar to what we've done before, but all you need to do is multiply the monthly payment, or P in this case, by the number of months in the entire amortization term, which in our case is 300, and subtract it from the total value of the mortgage, which we're calling F here. Once we plug this in, which you're plugging in $5,154.40, multiply by 300 and subtract 800,000, we get 1,546,320, and we subtract the 800,000 to get $746,320 that we pay in interest over the term. Now remember, our original mortgage amount was $800,000, so we're almost paying double, like really close to double. And as you can see there, that first, if you multiply the payment times the number of months, this is how much you've paid in total. So you've paid $1.5 million for a $1 million house that you already put $200,000 down for as well. So in total, it's more like $1.7 million for a $1 million house. Given how much interest we end up paying over the life of the mortgage, let's now take a look at some ways how you can reduce this, because this is crazy. Okay, so the first one that we're going to look at here is increasing your down payment. As simple as it sounds, this is the most effective way. And if you can do it, you should spend longer saving a larger amount of your total house that you want to buy. And this will actually reduce the interest over the life of the mortgage that you'll have to pay. The second, and this isn't always the most easy to understand, is making extra payments or adding extra to your monthly payment. What this does is it actually allows you to make a bigger dent in the total interest charge. And the reason for this is because we have to consider compounding interest. So some mortgages and lenders, you need to be aware of this. They actually don't allow extra payments. And in order to avoid penalties, this is also a good idea. Either have them show you that you can do this, or be sure to check the mortgage documentation to figure out if you are eligible to add additional payments. And it's also very important to talk to your lender and let them know that you're making an extra payment and to apply it only to principal. And the reason this is important is sometimes they keep the payment and they actually hold it until your next payment's due, which completely defeats the purpose. So make sure you tell them that you want to apply it to principal and that you're actually making an additional payment, not an early payment. Now, another thing that you can consider is paying your first payment on your mortgage. Say if you pay on the 30th for the first time, on the 15th of the next month, make your next payment. What this does is it actually reduces the interest over the life of the mortgage by 50%. And the reason this is because compounding has less time to work. So by shifting the second payment 15 days earlier, every subsequent payment in the amortization schedule is also 15 days earlier, and that accrues much less interest over time. Now, the third thing you can do to reduce your interest is to purchase mortgage points. And again, this isn't straight away that obvious. So what are mortgage points? And this is sometimes called buying down the rate. So mortgage points are a way to lower your mortgage interest by purchasing them for a typical cost of 1% of the total mortgage value. So say for an $800,000 example, a mortgage point would cost $8,000. Now what this does is it allows you to reduce the effective interest rate that's effective on your mortgage. And of course you need to crunch the numbers to make sure this makes sense. But essentially $8,000, or that 1%, gives you 0.25 or 25 basis points reduction in the total interest that you're paying. So if you're paying 6%, as we used in our example, you'd be paying 5.75 instead. And typically you can do up to 3 total percentage points. This will, again, depend on where you live. So in this case, if you do 25 basis point reduction for $8,000, we did the math here, and it adds up to $35,000 in reduced interest over the life of the mortgage. So in this case, that would absolutely make sense to do this. But in some cases, for example, when there's lower interest rates, this wouldn't make sense. The fourth thing you can do to reduce the interest on your overall mortgage is by reducing the amortization term. As simple as it sounds, it actually adds up very much in terms of interest, how much you're saving. So as with all interest, it compounds over time. And so if the amortization period is shorter, the compounding effect will be much less, and you'll save a lot of money this way. But of course, this isn't obtainable for anybody, and usually people who go with longer amortization terms is because they can't afford the current payment, and so they stretch it out over a longer term. We see this with cars as well. So this isn't always feasible, so that's why I've added it down a little bit further, but this is something you can do to reduce your overall interest. So for example, if you reduced it in our example from 25 to 15 years, you would save $340,000 in interest, or about 50% of what we normally paid in interest. And finally, one of the last options you can do is to refinance your mortgage as well. If you want a lower interest rate or interest rates are looking pretty good, you can always refinance and it can reduce your overall interest burden. But again, this is subject to what you find useful and, of course, the market conditions, since refinancing is very expensive. Well, thank you guys so much for sticking around until the end. This has been a look at mortgages and how interest works, amortization schedules. I hope this was useful. Let me know if you have any questions, and I hope this clears up some confusion related to mortgage interest.